Joining me now is Johnny Timpson from Scottish Widows Protect. Thank you for taking the time out to talk to us, Johnny.
You're welcome.
Just starting off really with the gender directive, what effect has it had on the protection sales?
Actually, if you go back to the period in question, I think we saw protection sales spike over that quarter period by about 7%, then fall back again. So in reality, although there was a lot of talk from a number of providers at the time, the gender directive itself actually hasn't had that much of an impact on sales. Some sales that would have been done anyway were done before the directive took effect. But we saw the market return to dip and then return to business as usual. In overall terms, protection sales are down year on year. And so we have major issues to tackle in the UK, and to some extent, actually, let's not get too hung up on the gender directive.
Okay. With regards to the effect of the RDR on the protection market, what changes have you seen, or what effect has it had on it?
Well, I guess if I take you back to 2011, and you look at the makeup of the protection market then, the individual protection market, roughly it was split 50-50 between bancassurance direct and independent intermediary. A lot of independent intermediaries, I think, were really concerned about RDR. Would they see a significant shift towards the banks? But you know what? The opposite's happened. What we've seen in the 3 years since is bancassurance distribution actually reduced in size quite considerably. Independent intermediaries have filled that gap, and what you've seen within banks is banks move away from face-to-face advice in all of their branch networks, which is what they used to have. They've moved away from investment advice. Unless a customer now is buying a mortgage product by and large, or buying a commercial loan product by and large, they're not going to get protection advice with it automatically. So by and large, the kind of protection interaction in retail bank branches now is probably non-advised. It's probably life only. So you can argue, and this is a bit like the proclaimers now, so where we are 3 years later, when it comes to face-to-face protection advice for mass market customers in retail banks, TSB, no more, because they haven't got face-to-face advice. Santander, no more. HSBC, no more unless it's a mortgage. So there has been a significant shift, if you like, towards the consolidation in the intermediary marketplace, as banks have shifted more to a non-advised and digital. But yeah, I think financial advisors actually, although they had the concerns, what they have done is demonstrated the resilience.
And with regards to PPI and the mis-selling scandal, do you think it's damaged the reputation of what essentially is a crucial product?
Yeah, I would agree with that. Actually, I think PPI has had we've had a number of issues with consumer trust anyway. So let's not pin it all on PPI, but PPI has certainly not helped, and we've not recovered from PPI, as well as we might have done. There are certain product lines, particularly, that I think are impacted by PPI, and IP is the income protection is the one that I'm, I guess, concerned about. I'm pleased to hear that the ABI have now got a review of the statement of IP best practice underway. Certainly one of the things I think we should look at there is, do we continue to call it IP? Yeah. Should we call it something else? And interestingly enough, if you look at income protection is a widely bought and held product in the United States, but it's called disability insurance over there. And maybe that's what we need to think about here. Let's call the product, let's label it with something that it actually people can identify with and a benefit it delivers. And I don't think income protection actually, as a name, works that well.
Yeah. Well, with regards to mortality protection, the gap in Europe, basically in the UK, we've got the third largest mortality protection gap. Why do you think there's still so much apathy from consumers about this type of protection, and how do you think this could be changed?
Well, that's a very good question, and I could speak for hours on this, but I won't. So, where we are in the UK, and if you think back to the Labour administration, we saw a rapid growth in welfare. We saw family tax credits. So I think that consolidated a belief that, the state, if things go wrong, I don't really need a plan B because the state will provide. Yeah. Equally, there's maybe and this has been proven in our own thought leadership and others, when we have spoken to consumers, they tend to overestimate just how much support is available from their employer, both in terms of mortality benefit or morbidity benefit. And these are the things I think that we need to challenge. Now, to some extent, what does that mean? Well, that means that financial advisors perhaps need to have a bit of a more detailed grasp on those working age welfare benefits that are provided by the welfare state. They are means tested, and in your circumstances, this is what that will result in. And by the way, if you do qualify for them, they are time boxed. So after a period of time when that benefit stops, then what are you going to do? So really start to have those more detailed, in-depth, engaging conversations. And that's really pertinent now because we're in the midst now of the biggest piece of welfare reform that's dropped in the last 70 years since the welfare state came into being. And not only that, I guess to some extent with the referendum outcome in Scotland and the prospect of devolved taxation and welfare across the UK, does that mean that we'll be seeing a different welfare and taxation structure in Scotland, potentially Wales and England? I think to some extent I would be resistant to that actually, because I think all that is going to do actually is cause even more consumer confusion. It's going to, if providers have to basically now cope with 3, potentially 4, depending on what happens in Northern Ireland, taxation and welfare systems, the amount of cost involved in that and effort involved in supporting that is going to be considerable. Bear in mind what's happening in the background. It's not as if we've got nothing else to do. We've already got a raft of pension reforms, but we've got enrolment to completely land and bed in. In addition to that, we've got a whole load of mortgage regulation which is running through the industry at the minute, and we're closely following it. We've got the European mortgage review as well. So there is a lot of change. I would be quite hesitant to basically say, right, let's carve up the fiscal and welfare policy in the UK into 4 different blocks. I think as an industry we'd struggle to cope with that.
I think people would agree with you as well.
Yeah, I hope so.
Yeah. Well, thank you for joining us, Johnny, and enjoy the rest of the expo.
You're welcome. Thank you.
You.